kind of make fun of you a little bit when you ask a question and a question and a question, but I really don't, because this is what makes this class interesting. You guys are supposed to ask questions, and you're not supposed to be like, yeah, we got it, even if you don't get it. Because really coming here to learn. So yes, I can tease you a little bit when you ask questions, because I do sometimes go away from the topic, but that's fine. The purpose of that is that I'm answering questions here, as long as they're not way too off point, and then I need to come back to them later. But yes, I encourage you asking questions. So please don't be deterred if I make a comment by it or something like that. So, all right. So we basically stopped the lecture talking about the determinants of the terminal cap rate. We basically said, okay, so it has to be equal to 10 treasury plus some risk premium, and then we're going to be reducing it by the rate of inflation, because this is how we can grow our NOI long term. Now, I want to talk a little bit about this risk premium, because Nusha is now in class, but she asked before she was in class about risk premium, and I'm sure that a lot of you want to know about it too. So here's how it goes. Basically, let's look at that. Let's look at this graph right here. Now, this graph right here, what we have is over 37, 38 years period. We're looking at the cap rate, again, average cap rate market, just talking in general what factors affect cap rates, and the 10-year treasury market. And we see that for the recent period, basically from the 1990s on, cap rates was always higher than 10-year treasury, but then before that we have periods that the cap rate was actually below 10-year treasury. So first of all, we need to understand what's going on, why this makes sense, and what caused this gap to close and open up over time. Okay, because that will help us understand and maybe predict treasury rates into the future. So the first thing is, does it make sense for cap rates to be below 10-year treasury? And usually when I ask this question, the answer is no, it doesn't make any sense, because why would you get lower return on real estate even with 10-year treasury? So you need to remember, first of all, cap rate is not your full return real estate. Your full return real estate is your cap rate plus G. Okay? So it's very possible that you have here somewhere that you have a cap rate of 6% and 10-year treasury of 8, but if your G, or rate of inflation, is 4%, then 6% plus 4, that's 10. It's bigger than 8, and it still makes sense. Okay, so yes, it does make sense in a rational market for having cap rates below 10-year treasury, because cap rate is only part of your return. Okay, so we can start with that. The other thing, of course, is that we have this early period before 1986 when we see that 10-year treasuries were a lot lower than cap rate, and part of that is because inflation was high. So you need to take your cap rate, add some pretty higher inflation, let's say 10%, and you're already getting to those numbers, and also factoring the fact of what I just told you about the previous tax laws that allowing people to write down real estate very quickly and sell those losses to other individuals or companies. So there's those things happening. So sometimes graphing things over time, and people like graphing things as long far as possible, that's fine, as long as you understand that different periods are affected by different factors. It is important. So just looking at the graph and say, hey, things are different, you need to understand what's different. But let's look at this period from this period on. Let's say from the mid-1990s all the way until today, we have similar tax environment. Yes, taxes change, 3% here, 3% there, but there is no really major change in the tax code. That's not a factor. And inflation was relatively stable, somewhere between 2 and 3.5%. So it was relatively stable around 2.5%. So the environment here, somewhere here from the 1990s on, is similar in terms of inflation and tax rules. But still, we see that there are some times where the gap between cap rate and 10-year treasury is big, and there are some times where the gap between them is small. You need to understand what's happening there. Any idea why cap rates or the spread between them will be shrinking or will be widening over time.
The difference between the treasury and
And the
inflation?
top rates.
Well, 2006 is right before the bull market.
What about the bull market?
So if 2006, the cap rate and the treasury
They're almost the
together
same.
in 2000 in 2006.
So I'm asking why.
2007, yeah. Because of the boom,
So what happened during the boom?
there's less risk. Properties are appreciating. So
Okay.
investors say, well, I'll put money in and I speculate or assume that properties are going to continue to increase in property value. So there's no risk. So they're trading at lower cap rates.
Okay, I think you're almost there. I think Pedro, I'll put it more in a professor-like terms, but you got it. But basically, here's the idea. If you think about the time like 2006, everybody is in love with real estate. Okay, because everybody's making money in real estate and has been making money in real estate for a long time, especially recently in the last 5 years. If you go back from 2006 back, everybody's in love with real estate because everything you touch is basically giving you very high returns. Investors have very short memory and very little knowledge about why this is happening. Remember the whole idea from very first lecture. There's a difference between knowing what happened and why. Remember NYU versus what happened versus why things happen. All that investors see, especially the naive investors, is what happened. And they see that in the past few years, returns were extremely high, which make them feel extremely comfortable about real estate, which means that they will be paying very high prices and they would not require very much premium. So the premium, if you tell somebody to invest in real estate, you don't need to promise them very high premium in order to encourage you to do that. They already encourage you. You just tell them, I have a property for sale. Okay, I'll buy it. You don't have to tell them, well, but it's also great property. Yeah. The property, it's 2006, you buy it. Okay? So basically, there's no difference here. Now, you can factor in the inflation and all that stuff, but basically the idea is that because inflation is relatively constant over time, so in relative terms, they're basically kissing each other, they're touching. On the other hand, if you think about it, just 2 years later, if you're talking about this gap right here, the gap is all of a sudden quite significant, almost as significant as it was at any point. It happened very, very quickly, because in 2009, guess what? Everybody hates real estate. Because real estate just collapsed in some areas 50% on average, and some other areas, more specific, maybe 60, 65%. And people that invest in real estate, all you need to tell them is that I have real estate to sell you, and all they need to say is that I'm not interested. Okay, forget about, don't even tell me I'm not interested, because real estate is just not the time to buy. Now, I know it's a little bit general, but basically that was that. If you try to sell property in 2009, you have to work really hard convincing somebody that this is a great investment, whereas in 2006, you didn't need to work very hard at all. Okay, so basically when you have to work very hard, really what it means is not that you're just a good person to convince them to buy or not. You have to show them evidence on average. You have to show them evidence of why this is a good investment. Basically, you have to show them that there's very high expected return. So the idea here is that during good times where things historically or recent history were very, very good, people feel very safe. They feel very optimistic about the market. They just did very well. They don't see the risk. It's there. It's actually there more than any other time because prices just went up a lot. But the feeling is that there's no risk. Everybody's doing great. All the time it went up and it went up smoothly. So there's no risk. At least that is the way to perceive. And therefore we're paying very high prices. The risk premium becomes very, very small. In times where people just lost a lot of money in real estate, the way that people perceive it is that there's a lot of risk in real estate. So the only way you can convince me to invest is if you pay me a pretty big risk premium, then I'll buy it. Okay? So basically, the risk premium over time is changing based on the perceived risk of people in the market. So I know I told you before that I don't like the word, bless you. I know I told you before, it's okay. I know I told you before that I don't like when you use the word feel in the report, because those technical reports, but when you talk about sentiment, this is exactly what feeling is, okay? It is, when people as a whole invest, the price they pay is really based on how they feel about the economy. Whether it is true or not true, usually or in many cases it's not true, because here, when the risk was the greatest, people required the smallest risk premium. And here, when prices were so low, so really the idea is that, you don't need to do anything for prices to, go back to some normal rate or normal prices over time. People were asking for very high rates of returns. But this is irrelevant to the fact that when people feel safe, they would require small risk premium, and when they don't feel safe, they require very high risk premium. So that is basically what caused those gaps to close and open up. Generally speaking, if you buy a property or invest in any investment, we have high risk premium. Historically, if you go back, you would see that if you buy in times where the risk premium was high, you'd be making much higher returns going forward. Because over time, it would converge to some average, which means that, you buy at a time where everybody wants very high returns. Now you sell it a few years later when everybody wants average normal returns. This difference is already yours. And that difference of 1 or 2% can already be incorporated into your cap rate, if you already know how it affects your returns. Okay, so that is basically about those basis points and how they change over time. So yes, each one of those components change over time. A fair assumption about what is the risk premium when you sell it, you don't know what's going to be the feeling in the market 8 years from now. Right? I mean, when I hate real estate, when I love real estate, you don't know, because it depends on how the economy is going to do at that time. So one thing is to say, you know what, I'm just going to wait for the time where the feeling is going to be one way or another. But sometimes you need to wait years or maybe even decades for the feeling about a particular asset class to really change. So you may not want to do that. And the other one is you basically assume that, hey, the feeling is going to be neutral. It's not going to be too optimistic, it's not going to be too pessimistic unless you have reason to believe otherwise. So you're taking the average of those risk premium historically and you apply it into your model. It's maybe not going to give you the right answer, but it's going to give you an average correct answer. And again, moving forward, we'll be able to have a spread there and be able to assume different risk premiums for the same project. We'll be able to run it in a more sophisticated way. But for now, we just need to guess one number, so the average would be the best number we can guess. And on the positive or negative scenario, you can play with this risk premium. Optimistic scenario is that people are going to love real estate, so the risk premium is going to go down. That means cap rate is going to go down, and your price is going to go up. A pessimistic scenario is going to go up. People are going to hate real estate, so you need to give them a very high risk premium to convince them buying your property. That means the cap rate is going to go up, price is going to go up, price is going to go down, and your return overall will decrease. So it's another factor that you need to take into consideration.
This is somewhat of an indicator of a real estate bubble, since treasury, 10-year treasury yields will probably go up, cap rates will go up. So real estate becomes more, that would mean it becomes...
What we have right now, we have a gap that is a little bit larger than usual, which actually is exactly the opposite of a bubble. But this is artificial. And the reason I'm saying this is artificial, so this is whatever the market determining, but this is artificial. And the reason I'm saying this is artificial because the Fed is purposely holding rates low, the short end, which affects the low end. And a lot of people would argue that if the Fed would just let rates do whatever they need to do, rates maybe will be here, and then all of a sudden you have the gap a lot smaller. So again, it's another thing is that just looking at the graphs by themselves, it's like, well, but now the gap is big. Well, you need to think also why it's big. And every time there's a little bit something different that is, a little bit something else that is different. And that's why, some of those questions you ask in class and I can answer you, and other things you basically, as you read about things and you learn how to think about different things. And guys, it's not about how to do best on the next project or how to answer this particular question. All those things, if you ask a question I'm answering in a particular way, you need to think about how it applies to other things. Because really I'm trying to teach you how to think, not how to look at this graph. Because this graph is going to change, a quarter from now.
Sorry. Do you have data prior to 1978?
I don't.
This?
Not reliable that I know for commercial real estate, so no.
Because there it touches 3 times. Like the treasury rate?
Yeah, but again, remember before that there was very different inflation that was all over the place.
It was always fluctuating.
It was very high and then very low, and then you have a tax that was changing, people anticipating that because it didn't just change one day. People were talking about it for a while, so people were kind of preparing for that. So I wouldn't really pay attention to the fact that it touched 3 times. No, I'm not a technical analyst, and it's to me this is irrelevant.
Okay.
I like to look at periods where things are relatively consistent, which I believe from 1990s, mid 1990s, it's probably fair. But somebody else can argue and say, well, I want to look at the whole period because of whatever. To me, the 1970s, 80s are just. You can still learn something from that, but in this context, not much. Because there's just so many other things that we just discussed that's affecting the gap between them. That. Okay? Anything else? All right. So, tying this back into about those terminal cap rates. Now, for your project, you can use whichever one you want. You can use this. That is the more single model, or you can use that, which is the pink model. Okay, that also give you a more sophisticated answer and control basically for the fact that cap rates do change over time. So that's why you have another week. I would suggest going with this because there's more information here, but you can use whatever it is you want. Okay, so we talked about leverage. We talk about cap rates. I want to go back for a second to talk about leverage and then tie into the next topic, which is taxes. So basically, there's a few reasons why people leverage. Right, Pedro?
Sorry.
There's a few reasons why people leverage. Number one, people leverage because they want enhanced returns. Okay, we saw that basically in this case, instead of getting 7%, you can get 9, or whatever the number was, if we have it. Whatever, that was 7 before. Okay, instead of getting 9, they would get 12. Basically, they get enhanced returns. So that is the main reason of why people leverage. Basically, they get enhanced equity returns. So basically, they can make a project that only return 9 and make it that return 12 because they take advantage of some lower funds. Another reason why they borrow, it's the obvious one that obviously they just don't have money. Okay, hey, this is 3.8. I don't have 3.8. I only have 1.5, so I'm going to borrow the rest of the money. The other reason people borrow money is maybe because, yes, they do have 3.8, but they don't want to spend it in one place. So they basically want to diversify and say, okay, I have $3.8 million, but if I put $1.5 million here and $1 million there, another whatever amount the other one, I can have 3 properties of different kinds. I less depend on one particular tenant. Maybe they're in different parts of town, maybe they're different quality, and have a slightly more diversified portfolio. So you're basically able to use your money and diversify a little bit more. We talk a lot more about diversification in the next course. Does it feel like everything I'll tell you that we'll talk about the next course? Yes. But I still tell you quite a lot in this course. So if I just told you, hey, we're going to learn about everything next time, and I say nothing in your class, that's a problem. But if you still get substance here, and I'm telling you there's a lot more to come, I think that's okay. But yes, we'll talk about portfolio diversification in my next course. I have to keep you staying, right? If not, you're just going to run out the door. And the other reason, there's one more big reason. Anybody know? So we talk about diversification, enhanced return. You don't have enough money, and there's another big one. Why people borrow? Well, because of low interest rate, they get enhanced returns. So it's kind of tied into that.
There may be a taxes.
There's a tax. I told you this is the next topic. So there's basically tax advantage. In the United States of America, it's not true everywhere, but in some countries, including the United States, which is where we're at, and we're learning about general cases here. Basically, the government is saying that you can deduct the interest rate from the interest that you pay toward an investment property. It's also not investment. You were talking about investment. The interest you pay for investment property, you can deduct it for tax purposes. Basically, you can make your tax lower, you can make your tax bill lower, and if your taxable income is lower, and that means your tax bill is lower, which means you getting higher return. So the idea is that the more you borrow, the more tax free you get, which, if you think about it, it's not a great way to run a stable economy because you're encouraging people to take more risk and then giving them a reward for that. Dangerous things can happen if you take it to the extreme. So I know a lot of people like those deductions, but if you think about it, on one hand, you get those deductions, on the other hand, you already pay more for properties because it increases the demand for those. So we'll talk about it a little bit later today. So basically, it provides you tax shield. Now, I want to talk, since we are talking about tax shield, I want to talk generally about how taxes are being, how they affect your return and how they're being calculated when you hold real estate. So, disclosure. So, taxes on income-producing property. So, disclosure. I'm not a CPA, and I'm not a tax expert. Okay, actually my wife is a CPA, but she was busy tonight, so she cannot come and tell you about those things, so you stuck with me. So what I mean by that is that the purpose of the next, I don't know how long it will take, planning on 15 minutes, probably an hour and a half, the purpose of the next whatever period is not to teach you about taxes specifically, just to give you a general idea of how the tax system works and how it affects your returns. Now, if you really want the exact, details of taxes, then that's why you hire a tax person. Okay? But you still need to have a general idea of what happened in different situations, what you're being taxed, what you're not. You get into the general picture, and then you hire people to do details that are not your specialty. Just like you hire a lawyer to read your documents because you're a lawyer, you're a real estate investor. Everybody have their own strengths. It doesn't mean that you should know nothing about real estate law. You should know the basics, basically just enough to know what to call your lawyer. The same thing here. Yes, you know the basic about the tax rules, but to know the details and how to take advantage of every detail in tax rule, call your accountant. But I still want to show you that. So first of all, we have three different kind of taxes. We can distinguish. We have property tax. We have income tax. And we talk about real estate, three types. Property tax, income tax, and capital gain tax. Okay? The very first one, it's the most intuitive, and it's already included in our analysis. Property tax is basically a tax that the local government would charge you because you own a property, and they need to maintain things around you, right? They need to have roads around you and provide services to you and police and security and all that kind of stuff. And that is one of the main ways that they collect revenue. So that's property tax. But we're not going to pay attention to that too much today because guess what? Property taxes, it's part of your operating expenses. So when we looked at, for example, here, NOI, it's already considering that property tax. Remember, NOI is your revenue minus operating expenses. Operating expenses, all the things that you have to pay in order to keep the property competitive. One of them is that you have to pay property tax, because if not, the state will just, or the local government will just take the property from you. Okay? Before any bank or whatever it is, they have the first right to your property. So we don't even spend much time on that. It is kind of tax, but it's already included here in your NOI. Then the other two are income tax, which you should be paying every year. Are you guys paying taxes every year? I hope so. Okay? Well, soon enough you'll make enough money to pay it every year. So income tax we will pay every year, and then we have our capital gain tax, which we pay only when we sell the property. And to go here just in one more detail, there's a difference between long-term capital gains and short-term capital gains. Long-term is anything that you hold more than a year, which is what applies to our properties. We're not talking about gambling, about properties, buying them today and and sell them 3 months later, even though if you are a flipper, that's maybe something you do, so you have a higher capital gain tax there. But for those investments we discuss here, you hold them in vast majority of cases more than a year, so the capital gain that applies is a long-term capital gain. Okay? So every year capital income tax, once you sell the property, it's a capital gain tax. All right, so if you,
I'm sorry.
yes,
Talk about, I can't articulate like a 1031 exchange.
yes, we'll talk about when we talk about the capital gain tax.
Okay.
So in order to calculate your income tax, you first need to calculate your taxable income tax, so the amount on which you will pay taxes. And basically the way it works in the United States and in many other places is pretty similar. First of all, they take your revenue. They subtract from that operating expenses. Okay? That is basically
You got the X?
revenue,
No, to the left of the equals.
taxable income tax.
Income tax.
Okay, taxable income tax. So the first one, they say, okay, how much money did you collect from everything? Okay, that's your revenue. Minus what were your operating expenses, which included maintenance, property tax, insurance, all those things you need to do for the property, management, all those things, operating expenses. So those basically, this is your NOI, revenue minus operating expense, NOI. Then from that, you subtract your interest, and you subtract also depreciation. So revenue minus operating expenses, which is your NOI, minus interest, minus your depreciation. Remember, when we subtract interest, we only subtract the interest. We do not subtract the whole payment we pay the lender, because if we have an amortized mortgage, our mortgage includes interest and principal. We need to separate the two and only deduct the interest. This is the only thing we're allowed to deduct. Okay, so for example, if we have a property with an NOI, so so the interest will be only the interest, not the principal. Depreciation. In the United States, we have two major types of depreciation when we talk about real estate. There is one depreciation schedule, which is for residential real estate, and another one for commercial or non-residential. So residential will be housing, apartments, condos, anywhere people and their families live, okay, or should be living, and non-residential is everything else. So retail, offices, industrial, whatever it is, that's non-residential. Residential properties are being depreciated over 27 and a half years. Non-residential properties are being depreciated over 39 years. Now I know that this is the point where one of you is going to raise your hand and say, why? And usually I think I'm pretty good at answering why, but here I'm not because I don't know the answer, because there is no really a reason why. When you're talking about tax rules, it's basically, theoretically, the depreciation should align with the shelf life of the product. So if something should last for 27 years, it should depreciate over 27 years. But in this case, it has nothing to do with that. It's simply because they just had to pick a number, and probably one part of the government say, we need to do it 40 years, the other time we'll do it 20 years, and probably, 27 and a half sounds good. It really is probably something like that. I'm exaggerating a little bit, but there is no really economic argument of why to do 27 and a half versus 30. It's just the way it is. Okay? Because you depreciate 27 and a half, whether it is a good quality property, whether it is a bad quality property, whether it is a new property, whether it is an old property, whether it is, whatever it is, it's 27 and a half years as long as residential. So it really has nothing to do with the economic value or the shelf life of the building. So I can't read the explanation. Why? I'm just telling you this is the fact. Now, it may change in the future. Still, the methodology stays the same. It's just going to be 27 and a half. It's going to be whatever other number. Okay, so you need to realize that any numbers we put here may change over time, but the overall system at least for a while, stay the same, and it's probably likely not to change too much the way that everything is calculated. So that's 27.5 for non-residential is 39. And one more thing about this, you need to remember that the only thing you can depreciate is the structure, not the overall value of the property. So for example, if you have a property that you bought for 3 million, and the estimated land value there is 1 million, that means that the structure is worth 2 million. And that 2 million will be depreciated, depends if it's commercial or residential, over 27.5 or 39 years. Basically take this amount, you divide it straight by 27.5, or you divide it by 39, and this is the amount you're allowed to depreciate every year.
In a multifamily, which is it?
People live in family and multifamily?
Yeah,
So it is.
residential?
Yeah.
Even though it's a commercial investment, like the, for.
Yeah. So that's why we don't. Sorry. So we don't call it residential and commercial. We call it residential and non-residential. Residential is 27.5. Non-residential 39. So I know in the beginning I misled you when I said commercial because I'm used to saying that, but
Okay.
yeah, commercial real estate people refer to all investments that people buy for. Sorry. For yield, basically in producing properties. But here we're talking about residential, non-residential. So apartment buildings will be residential. Okay? So let's do a very simple example. So for example, if I have something like 5 years ago, you bought an office building for 5 million, where the land value was $500,000. That's one piece of information. The other piece of information is that this year, NOI was $300,000. And you had $100,000 of interest expense. Last piece of information, your tax rate is 30%, and I'm asking you how much income tax should be paid. Okay, so basically all we need to do is calculate our taxable income using the information we have. We multiply it by our tax rate, which is given to you here at 30%, and that will be our tax bill. Okay, so how do we start? We start with our NOI, or basically revenue minus expense, which is an NOI. So taxable income. $300,000. That is NOI. Minus interest. 100,000. Minus depreciation. How much is my depreciation? We have 5 million that we bought the property.
Pulling out.
The land was worth half, so the building is 4.5. It is an office, so it's non-residential. So we take 4.5 divided by 39, which will give us, so let's do that. So depreciation, we'll put here inside. Depreciation is basically 5 million divided by $500,000 divided by 39, which is roughly $115,000. Right?
And I'm sorry, is this per annum? Is this like
Yes.
every year?
Every year you will
accumulate?
depreciate your property by $115,000. It will not change with the value of the building. It will still stay $115,000 every year. So once you calculate one time, it will stay the same. Now, if we really get into details, there's other things within the building that you will depreciate differently over time. So for example, you can if you are having furniture or appliances or art or whatever it is in your building, you can depreciate those things too. And some of those things depreciate over 3 years, some of them over 5 years, some of them over 7 years. So you replace the fridge, all of a sudden now you have a new depreciation. We're not going to deal with that. Those are important details, but it's just too much details for that. I want to give you the big picture. So for the structure, it's the same every year. So per annum. So basically, in that particular year, you can deduct here another $115,000. That is $85,000 is your taxable income. So basically, even though you made $300,000 this year, you tell the government that you only made 85, and therefore you pay tax on 85. So your tax bill, the tax amount, is basically 85,000 times 30%, which is roughly $25,500. Okay, so basically you estimate your interest, you estimate your depreciation based on your NOI. It will tell you that your tax that year should be about $25,500. So even though your tax rate is 30%, 30% on 300,000 is 90,000, you really are paying 25.5. So the whole idea about the debate about, well, but the tax rates are low, but the deductions are high and all that, because you can make tax rates very high, but if deductions are high too, you end up paying less than 10%, right? 25.5 divided by 300, 25 would be 8%. So really your actual tax is about 8% here, not 30%. So people can pay taxes when they want. Generally speaking, from studies that people have done, it's actually better to have lower tax rate and eliminate deductions. It just works better in terms of incentives because those incentives apply to everybody, rather than have high tax rates and then play all those tricks of how can I deduct as many things as possible. It's just not an efficient way of doing that. But we're not talking about what's efficient, what's not, talking about what's actually happening. This is the way it works. Now, other things that you can deduct over time. So for example, if you have points on the loan when you bought, remember a point would be 1% on, 1 point would be 1% of the value of the loan. So for example, if you took a $2 million loan and you paid 2 points, well, 2 million and 2 points would be $40,000, right? So $40,000, you can basically deduct those 40,000 over the life of the loan. So if you took the loan for 10 years to keep it simple, and you paid initially 40,000, you can deduct every year 4,000. So it would be minus another 4,000. Again, those are details, but it's a pretty common event. So if you have it for 40,000, 10 years, 4,000 every year, if you happen to sell your property after 5 years, you deduct 4,000 year 1, 2, 3, 4, 5, and then when you sell it, you can deduct all the rest, whatever left. Okay, those are details, but just so you know, people are sometimes asking about points. Now we do have the other tax, and then we're going to put it in the Excel together. And the other kind of tax is the capital gain tax. Now, in order to determine what is the capital gain tax, there's a few moving pieces there. I like to draw it this way. You have the price paid. Okay, you pay a certain price for the property. Let's say that this is $4 million. Okay? Then you have, at some point, when you sold it, you have the selling proceeds, which is basically how much you got for the property when you sold it minus commissions and things like that. So let's say you sold it for $5 million, you have some commissions for agent or whatever it is, and let's say you net 4.9 million, so that will be 4.9, or whatever the number is. Now guess what? On this amount, the government is going to charge you tax when you sell it. And Then they're gonna charge you a different tax on something else. And there is also the price right here, which is the, I'm gonna call it the accounting value. Accounting value or the depreciated value, it's the same thing. And that is basically how much your property is worth according to your accountant. Okay? Property was worth $4 million when you bought it. So the accountant, when you bought it, they wrote in the books that you have a property that is worth $4 million. And then every year you depreciate that property. Every year they allow you to depreciate by whatever amount. So let's say you depreciate the property by $100,000 a year, just to make it simple. And you sold it 5 years later. So a year later they told you your property is worth $3.9. 2 years later they told you it's worth $3.8, $3.7, $3.6, $3.5. When you sold it, according to the books of your accountant, your property is worth $3.5 million. Or whatever other value, but it's going to be lower than the price paid. The government is going to charge you tax on that too. And the rationale behind it is that you first get the deduction, and then you have to pay it back. And you're kind of thinking like, so why do they charge me and then take it back? Can we just not play that game? Well, really, it works to your advantage for two reasons. First of all, you get the deductions first and pay the tax later. So that's the time value of money. You always want to get things first and then pay later, even if it's the same amount. So that's what your benefit, right? Because you only pay it at the end when you sell it. But deduction you get in year 1, year 2, year 3, year 4, and then you only pay the taxes in year 5. So that's one advantage. The other advantage is that the tax rate that they charge you here is different and actually lower than the value of the tax benefit you receive. So the tax benefit you receive, remember, every time you depreciate, it's according to your marginal tax rate. 30%, 35%, 39%. Most investors invest in real estate, if they're wealthy, they're probably in the 35, 39%. So every time you depreciate, they're getting a pretty big tax cut. Okay? But when they pay it back, according to current tax rules, that can change, but it's usually lower. On this amount, we pay 20 or 25%, depends on your how much money you make. Okay, so I'm not sure what I put in the spreadsheet. I know 25% is the highest. I'm not sure what I have there. Okay, 25%. So for wealthy individuals, which is usually the one who buy a $4 million building, that would be 25%. And then on the capital gain here on top, it's going to be 15 or 20%. For the very wealthy individuals, will be 20%, but it ranges between 15 to 20 to wealthy people. It can be 0 if you really make very little money, but that's not applicable because if you make no money, you don't have this property. So it's irrelevant. So this number would be 20 to 25, depends on the wealth. This number would be 15 to 20, depends on the wealth if people apply to those categories. And just for comparison, the same kind of people that do pay 15 to 20 or 20 to 25, their marginal income on income tax will be about 35, 33, 39. So the taxes we pay here at the end are lower, and we pay them later. So that's the advantage. Lower rate, and it's more in the future.
That's you. So we're right on the top one.
I'm sorry?
Can you explain that again?
Yes, on this gap, you pay 25%, and on this gap, you pay 15%. So 15 to 20 depends on what is your wealth level and income level, and 20 to 25% depends on your income level. So you can look at the tables, go to the IRS and see exactly what it is. Depends on how much money you make. I think if you
The
make,
highest, I guess, is what, 39?
for income tax is 39.6, yes. Yeah. So the 25 start peaking at around $300,000 a year, which is not very high. Most people that invest in properties have at least that much income, so they would pay 25.
Yeah, this is going to reflect later in your personal. Anyway.
Yes, because in many cases you're going to have an LLC that is paying to your
Personal.
personal, and then you pay taxes at the personal level. That's what most people do. Talking about corporation, that's a lot more complex, but still the rules are pretty similar. Okay? Any questions on that? So if we have a property, let's do another simple exercise. And then we'll do it with Excel. You bought residential for 4 million. After 5 years, you sold for 5 million and paid 4% commission. And the land value at purchase was 1 million. What is your estimated capital gain tax? Question mark. Okay, so again, we start here from the 4 million. The amount we sold it for is 5 million minus 4% because that's the sale proceed. 4% on 5 million, that is $200,000. So you end up with 4.8 million. Right? On the other side, how are we doing, Lily? Lily?
Oh, no, sorry. I
Okay.
just missed that part that you buy for 4 million and then you sold for, I was
For 5 million. but
You,
then
you bought for 4.
2.5%.
Can't you see my handwriting is so
Perfect.
clear? You
I
cannot get it
was
wrong.
writing and
It's
thinking
written
like.
so clearly on the board.
No, I was thinking.
This is why people do a 10, 31 exchange, so they don't have to pay.
Yes, so, yeah, that's
for
what
that.
the caveat at the end.
Okay.
So, okay, you bought for 4, so for 5 minus commission is 4.8. Again, I told you, it's my handwriting, I know, especially because this is like this, and my handwriting to begin with is not very good, so stop me when you can't read it, because that's when you see your face like, what is it? All right, 4.8, and then on the other hand, you have a building that this structure itself is worth $4 million because you bought it for 5, the land value was 1, so the structure was 4 million. And this is a residential. You have residential structure worth 5 million minus 1 million, which is 4 million, which means depreciation is 4 million divided by 27.5. What is that? I'm sorry?
Don't you take away the land value?
I took into consideration the land value. Otherwise, it's 5 million minus 1. So that's 4 million.
Or
But that's what you-
Oh,
That's what you bought it for.
sorry. Where are we?
We bought it for.
You're right,
You
sorry.
bought it
So
for
it's
4
4 minus, thank you. Thank you. That is 4 million, that is 1 million, that is 3 million, thank you. So that is 3 million divided by 27.5. And 3 million divided by 27.5,
109.
109,
Yeah.
okay? So 109,000. And how many years did you depreciate it?
5, right?
You depreciated for 5 years because you bought it 5 years ago, so you did it 5 times. So your total depreciation over the period. So remember, every year you write that the building is worth $109,000 below what it was to begin with, starting with 4 million. So total depreciation is 5 times 109, which is 545. So your depreciated value or your accounting value is 4 million minus 545,000, which is 3 point, it's like, 3.5 minus 45, so it's 3, 4, 5 million. Okay? And it depends what tax rate you apply here. If this is a wealthy individual, this will be 25%, and this will be either 15 or 20. Let's call it 20. So this will be 15 to 20, this will be 20 to 25 in most cases. Let's just finish that and then we'll do. So basically you have 800,000, which is the difference between this 4 million and this 4.8. And we're going to be multiplying this 800,000 by 20%. And then we're also going to have this difference, which is 545. And we multiply that by 0.25. And together we're going to get, anybody with a quick calculator? This is 160, and this is 160, and this is a quarter of that, will be about 129. Pedro. I don't know. Pedro will check us.
Can't see you. I can't.
25. 1 second. 47.
Okay, 296. The tax bill when you sell this property is going to be nearly $300,000. Okay? So yes, tax environment in the United States is friendly, but when you sell this building for 4.8 million, well, you sell it for 5. You give $200,000 to the agent. You give another $300,000 to the government, and you're left with 4.5. Well, it is what it is. You have to be prepared for that. But this is basically how this environment looks like. Now, a lot of you, the details here, yes, this is the general rules. Tax can be changed. The system itself is basically staying the same for a long time. So it's really important to understand the system even if the numbers change. What I want to touch based on the fact that those taxes are very high, the government have whatever they call 1031 exchange. Okay, so basically what the government is saying is that, hey, we want people to invest in real estate. And actually, 1031 exchange is not just for real estate. You can do it on airplanes if you are American Airlines. So you can do it on any kind of asset, but when real estate costs, so we don't know about real estate. But just so you know, 1031 is just not just for real estate. Actually, it's the most common on airplanes, because those are the bigger assets that those companies that sell them, and they basically depreciate to zero. When they sell some amount, they have huge tax amount that they want to avoid, they do 1031 exchange. But in the case of real estate, basically the tax is written that way. And again, I'm going to make it very simplistic. First of all, because I'm not a lawyer. And secondly, because even if it was, this is not a place to talk about each other. The idea is the following. If you are investing the same amount or more relative to your selling proceed, in this case, if you are taking this 4.8 and you're investing at least 4.8 million or more in a similar kind property, so like kind property. And like kind is pretty general. It doesn't have to be office for office. It doesn't have to be retail for retail. Basically, have to be some kind of an income-producing property. You can sell an office and buy a retail. You can sell an apartment and buy a farmland, whatever it is, it's fine. If you do that, you do not pay taxes at all. This $300,000 is being not disappearing, but it's being delayed until the next time you sell a property. Okay? Except you can do it over and over and over again until, hate to break it to you, you will die at some point in your life. Not your life, it's going to be the end of your life because you're going to die. And at that point, this is basically forgotten. So you can avoid those taxes, essentially, which is what else people do. And the idea here is the government, they want you not just to sell a property and then take the money and sit on that. They want you to reinvest because when people invest, it's good for the economy. Whether the tax code is correct or provide the right incentives, that's a different discussion, but basically that's what they want you to do. So as long as you are selling the property and reinvesting it, buying a like-kind property within some short period of time, in the short period of time, you should have
Same amount or more.
60 days to identify,
180.
6 days to identify, and another, or 90 days to
45 to
identify.
180.
45 days to close.
Before the tax, 90 days.
What is it, I'm sorry?
Like 45 days to close after 180 days.
And you can get an extension,
You can
but,
extend it.
yeah, you can extend it. I really do not know, this is not my strength. So I don't know all the details, but I know that there's something within a relative short period of time, you put your money basically in an escrow account, that then within a short period of time you need to invest it. And if you do that, then you basically have those taxes postponed and you do it for
You can also trade the property, right? Or no?
the same. Yes, you can trade it for shares, for example.
But you can also give it away, right? You can do a gift.
There are different rules on gifts. You cannot give gifts that are too big if it's to your family, for example. But if you give it like to a charitable entity, there are different rules. I think you can give as much as you want to a charitable entity. But if you give it to your kids, you can't give more than a certain amount every year, so there's rules there. Again, that's where you step outside of my comfort zone. I don't know the details, but yes, I know that there's some limitations there. Now, those tax rules create a few inefficiencies in the market. The very first inefficiency is that, okay, I'm coming to sell this property, and I don't want to pay tax, so I need to buy something else. Guess what? When you're under pressure to buy something else, you're probably not going to buy and find the best deal. You're going to be looking for something, and your max price is $5 million because that's what it's worth, and the lowest they're willing to go is 5.1. Usually you say, you know what, forget about it. I'm only paying 5 because that's all it's worth, and you're asking you're asking $100,000 too much, so I'm walking away. Here, you're going to say, I know you're charging me too much, but I need to make a deal now, so I'm going to overpay $100,000 to save myself $300,000. So in many cases, you have some inefficiencies there, that people, because they are rushing, they have to rush to buy a property. They not necessarily, in many cases, don't get the best deal they would get if they just have, hey, I have some money, and I'm going to find a property when I find it. It may take 6 months, may take a year, may take, you are much more relaxed, you're also more power to negotiate. You can really easily walk away from a deal that doesn't seem favorable. Here, you're under the clock, and even if you get a deal that, I'm not saying you're going to get into a terrible deal just to save it, but you're going to get into a deal that is maybe not as attractive as you would otherwise. That is one inefficiency. The other things that those codes create, not necessarily 1031, but the depreciation. Remember, this depreciation, whatever amount it is, $115,000 or $109,000, it's the same amount every year forever. If you have a property that you bought $5 million, let's say the land was worth $1 million, so the property is worth $4 million, and based on that you have a certain depreciation. And over time, this property went up a lot in value. You're still getting the exact same depreciation. So what you would want to do as an investor is saying, well, how can I get a higher depreciation? I can sell my property, trade it for exactly same property, just for, illustration purposes, the property next to you. So your property you bought for $5 million, now it's worth 10. You're still depreciating it as if it was $5 million because that's the rule. And there's another building right next to you, and this other person bought it, again, for illustration, but also bought $5 million, whatever it is. You have the same building, the same kind of tenant, the same NOI, everything is very, very similar. You can basically trade buildings. So basically you sell yours, buy his for the exact same price, and you get a new depreciation clock So now you can again depreciate the building over 27.5 years. It starts from time 0, and you depreciate based on a 10 million valuation, because that's what you bought it for, not a 5 million valuation. So you basically get a much bigger depreciation every year, and even though the building operates and generates the exact amount of money, you actually make more money at the end because you pay less taxes. So again, those are the kind of games that investors play when they understand the tax rules. So I'm not saying that, I'm just saying that is why it's good to know those things exist. You're not going to build the details. I'm assuming nobody here is have passion to be an accountant. Yeah, me neither. But it's basically to understand those things exist and why people behave in a certain way or they do. Let me show you how it works in the Excel spreadsheet. Now, this one you do not need to include in your report. Remember, in your report, I'm only asking about the before tax. So don't even go there from the extra mile. This is not part of the report. Don't worry about it. Okay? Even for the very ambitious students here. Everything here is the same, except few values here. We have marginal tax rate, 35%. Tax rate on capital gain, 15%, which is the appreciated portion, and tax rate on depreciation recapture, which is on the depreciated portion. Remember, we have this. We have the appreciated version, which is the regular capital gain, and then we have the depreciated portion. So each one is different tax. And here, put whatever it is realistic for our assumption, but then here put 15 and 25 and 35 for the capital gain tax. Jessica,
Yeah.
how are my color choices here? Doing okay?
Yeah, I mean,
Not that one.
You don't like this one? Any suggestion here? No. Is this better? Is this better?
no. I think the color of the text has to be black. In the background,
I'm just going to bore you with a white, with a black text, because that's what you're asking for. Here's a black text, and here
I think it's just
is a white. I don't care if it's pretty.
yeah.
It's good. Okay?
I mean,
So,
that's
okay. Column number 1, taxable income. So basically the way we do that, just like I explained before, we are taking our NOI, which is revenue minus operating expenses. We subtract from that our interest. Remember, this is our table of interest and principal. This is the interest component in year 1. This is the interest in year 2, and so on and so forth. So that is the interest in year 1, 138. We subtract that. And then we subtract the depreciation, which in this case happened to be 94. Just to show you how I got this 94. This 94 is basically the price we paid minus the land value divided by 27.5 because it's residential. Okay, so every year, this is my taxable income, the amount on which I need to pay tax. So again, we'll go to like year, whatever, 6. Again, it's my NOI minus whatever it is the interest I pay at that year, which is 116. Interest is going down over time. In this case, because it's an amortized mortgage. And then subtracting again my depreciation. So 1 minus 2 minus 3 gives the taxable income. So that's how much we need to pay tax on. The actual income tax, the amount that we pay tax, and that's why it's negative number, it's basically going to be that number, whatever each number of these is, times that 35%. That is my marginal tax rate. So this number times my tax, I put it as a negative because I'm paying it out. So in the first year I'm paying 8,000, then 12, then 16, and so on and so forth. And the idea, the reason I'm paying a little bit more tax every year, first of all, because I make more money, and the things that I deduct become smaller. The depreciation stays the same, but I deduct less and less interest because I'm paying less interest. So whatever I have left is bigger, applying 35%, I'm paying a lot more tax. still, those are very small amounts. And when we pay 8,000 on 256, that's like, let's say 4%, it's like 3%. Okay? So that's my income tax. Capital gain tax. In this case, the capital gain tax is 311,000. And again, just like in the example, but let's point to the values. We have first one, D24, which is how much we sold the property for, minus how much we bought the property for, times that 15%. That is the first portion. Bought, sold, the difference multiplied by 15%. Okay? The second portion is the depreciated value. So, bought minus accounting value times 25%. So, second portion is my bought minus, and I have here the depreciation schedule. We start from 3.8 million, which is what we bought the property, and every year I depreciated it by that amount, $95,000. So when I sell it, according to my accountant, my property is worth $3 million. So the difference between 3.8 and 3, which is about $750,000, on this one I'm paying 25%, adding them both together, 311. Then you have your after-tax cash flow. And your after-tax cash flow is basically how much money is flowing in and out of your account after you account for taxes. So we already accounted for leverage before. Those are those values. So all we need to do is take this value, which is 55,000 in year one, and so on and so forth, and add to them those negative numbers, whatever they are. So after I made 55,000, remember how I made those 55? Because I generated 256, and I had some payment to pay the bank was 200. I ended up with 55, and then on that 55, I need to pay another 8, so I'm left with 47. And then in this year, I'm left with 51, and so on and so forth. In the last year, again, instead of my 4.9 that I sold the property for, I'm left with 3 million because I pay back the mortgage and all that. Then I'm paying my regular tax every year. I'm paying my capital gain tax, and then end up with 2.7 million. You can also take the present value of those, just like we did before. Present value of this column was that column using the present value, future value. Look at it later if you want to get reinforcement, but it's the exact same way. So this is the present value of cash flows. This is cash flows. For the sake of consistency, I probably want to put a dollar sign here and eliminate some of the pennies because I tell you not to do it, so I should not do it either. Okay? And then I'm calculating the return. So basically my return on that investment after tax is 10.3. Okay, so before leverage was 9.3. After leverage is increased to 12.8, but because I need to pay taxes, because we're getting some for taxes after all, the actual return to investors is 10.4. And guess what? Investors, this is all they care about. They don't care about how much money they make before taxes. They care about how much money they make after taxes. Okay? So we need to be able to estimate that. That is not to be the exact amount because they have other things going on, but it's going to be the estimated rate of return.
What do you think, good deal? Considering the
This is a made-up deal.
But is it a good deal?
If I can get 10.4% after tax on if this is a average quality property, I would buy it.
What's the cap, 6.75?
Yeah. It doesn't mean it's good. It means that I think it's good. In today's environment, if you're an average getting 10.5% after tax on a relatively stable investment, you're going to do very well. Questions? 5 minutes break, but like 3 minute break, so it will really be fine. 3 minute break. 3 minute break, guys. Just stretch, go to the restroom, come back. We'll come back for another 50 minutes or 40 minutes. 30 minutes?
No, it's fine.
Last pledge. So, the very last thing I want to talk about is about the market inefficiency. So we're going to be, again, I am aware that those lectures are long, right? I know that. That's why I'm trying to finish with things that are a little bit less technical because I know that's where your attention is becoming a little bit more problematic. So we're going to finish with something a little bit less technical, but still, I believe, very important. And that will be basically the efficiency of the real estate market. Okay? So when we talk about the market being efficient or market being inefficient, here's what it means, especially when we talk about finance or basically finance bills. When we talk about efficient market, it basically means that assets are selling for what they're worth. Okay? So if you buy a particular asset that is worth $3 million, the price of that asset will also be $3 million. And if you buy this other asset that is worth $2 million, the value of that asset will also be $2 million. Okay? Now, there's a lot of reasons of why this happens in many cases, because if something is worth $2 million, why would you sell it for 1.8? Okay? If somebody is willing to pay you 2 for that, you should be selling it for 2. And also, if something is worth 2, why would you sell it for 2.2? Why would somebody be stupid enough to pay you 2.2? So the idea is that on average, prices should equal their value. And it is true on average, except that we don't really care about the average, we care about what happened around averages. There are many cases where that is not the situation. Now, let's talk for a second about the stock market before we focus about the real estate, because I think it's a good comparison. Cold coffee. So in the real estate, in the stock market, basically what we have, and the most common hypothesis there that people talk about market efficiency is the efficient market hypothesis, again saying that every stock is selling for what it's worth. And the idea here is that if it's not, things are happening so quickly that we basically force it back to whatever it's worth. So if you try to sell something for 50 that is only worth 47, people will immediately identify it, stop buying from you until the price will drop to 47, and then they would buy it again. That is the efficient market hypothesis. And I need to realize that even in a market that is efficient, you can still make money. Okay? If you buy something for 50 that is worth 50, it doesn't mean that you don't make money. It's worth 50, you pay 50, but you can still generate income on that. Right? You get your rent, whatever that is, and then in a few years it's going to be worth 55, so you have your price appreciation. So you can still make money if you pay fair price. I mean, think about it. Most of us, yeah, I know we all think that we're making those great deals, and sometimes we do, but for the majority of the time, when you buy a property, you pay what it's worth. Right? Doesn't mean that it's a terrible deal. Doesn't mean that you cannot get return on that. It just means that you're not going to get abnormal returns. You get the returns that are fair for that type of assets. So again, maybe this asset here, think about it. This asset, I buy it for 3.8. I decided it's worth 3.874. So let's say it's roughly around, even if I buy it for 3.74. It's tied with the other thing, so it's not going to be, yeah. So I buy it for 3.874. It's worth 3.874. I can still make a return. Okay, just because I bought what it's worth doesn't mean I'm not going to return. So I want you to understand that. So you can make money in an efficient market. However, intelligent, sophisticated investors actually like markets that are not efficient. Because in markets that are not efficient, you can identify those properties or those assets that are worth 3.8 but are selling for 3.5. And if you buy those properties, then you can get the regular return you get if you were to buy it at 3.8, plus this extra $300, $300,000 spread over whatever time period, you can get this abnormal return. So you're getting the return you should get plus something extra. That is what happens in markets that are inefficient. Okay, you can identify things that are worth one number and selling for a different number, and if you are sophisticated enough to recognize that, you can take advantage of the situation.
When you refer to inefficient markets in general, do you refer to a time frame in history, or do you refer to a specific marketplace?
Okay, so inefficient market can happen during different time periods, can happen during different locations, and can happen from one property to the next. So it can be that the low property is selling for what they should, but there's a few that don't, so those are the ones we focus on if you are that kind of investor who's looking for undervalued properties. It can happen that during some times where everybody hates real estate or whatever it is, selling them well below what they should, so during this time frame you have all properties are undervalued, and you have some other times where all properties are overvalued, so you probably should not touch them. So it can happen 3 times. And can happen in different locations, which means there's some areas where the market is relatively efficient, and some other areas where there's a lot of dispersion. So it can really happen in all those scenarios. Okay? Now, the real estate market is very inefficient in relative terms if you compare it to the stock market or the bond market. As a general guidance, if any of you is a stock trader, please get this habit off your, I don't know even what the term, but the stock market is so efficient that people cannot make money trading stocks, okay? And I can give you one evidence for that, and I know that a lot of students don't like hearing that, because it's like, well, Dr. B, whatever, you're reading the book and you do all this research, but we know how to trade stocks, so it's, of course it's like, you can, but I can because I'm just really smart, and maybe you are very smart, but you still cannot make money long-term trading stocks. And the idea here is that the markets, they're so efficient that by the time you are paying for transaction costs and by the time you're paying for taxes that you're paying when you make money but you don't receive the credit when you lose money, you cannot make money long-term trading stocks. A lot of people would like to tell you that you can because they're selling you those trainings, etc., but you can't. Prices there are extremely, extremely efficient. One of the proofs to that nobody can really make a significant amount of money trading stocks is that if you're looking at the Forbes 400 list of the richest people in the world, every year they issue that list of people, the name, how much money they have, and how they made the money. Look at this list, not just this year, but the year before, and the year before that, and the year before that. If you find one person in the whole list that the description of how to make the money is trading stocks, please let me know. They're not there. People make money on long-term investments because they're entrepreneurial, because they have long-term investments, because they have inventions, because they inherit money, because they marry into money, all those things, but not because they trade inefficient markets. Whether it's currencies or stocks, it just doesn't happen because it doesn't mean, it's just impossible for a person to always consistently buy something for 53 that is worth 55, make this spread and do it over and over and over again consistently. It just doesn't happen. Okay? On the other hand, and if you think about also, and I'll talk about some of these reasons, I guess I'll talk about some of these other reasons. On the other hand, on the real estate market, you have a lot more inefficiency for the reason we'll discuss in a second. And because of these inefficiencies, intelligent investors that have the good information and knowledge can actually make abnormal returns. So the fact that the real estate market is less efficient is very good for people like you that learn about real estate. So let's talk about a few of the reasons why the real estate market is inefficient, because remember, it's not just me telling you, oh, it's inefficient, so it's good. I'm telling you, explaining why, and then I will show you some evidence for that. So, first of all, we talk about professional players. If you think about the real estate market, most players are not professionals. most people participate in the market. There are people who buy their own homes. They buy it because they love it, because they like it, because they whatever. They buy it for whatever reasons, but they're not professionals. They're buying a home once every 8, 10 years. They don't know much about it. They're doing something else. They're not really professionals. And even people that invest in real estate, unless you're really talking about the high end, a lot of them are not really professionals. They're just people that happen to have some family money or they accumulate money in some way and want to invest a few $1 million here and there. Many of them don't really, I can't really consider them to be professionals. They don't really know what they do. That is, and I will compare every time to the stock market. That is very different than the stock market, where the majority of the market is being owned by professionals. Even money that's being managed for you and whoever else that is maybe not a professional investor is invested by mutual fund managers, hedge fund managers, etc. The vast majority of money being trading hands is being exchanged hands by professionals. So when you have a lot of professionals that are changing the same assets, and they're all using the best methodologies, valuations to determine what things are worth, it can't be that you are going to be smarter than all the rest and always buy only the things that they're cheaper than what they should be, okay? Because in the real estate, it's not that way. You can always take advantage of the less professional investors or consumers in the market and buy it for a lower price than things should be. And they have all those kind of different reasons of why sometimes they sell for prices that don't make sense. For example, a lot of that is based on emotion. People buy and sell real estate, and I'm sure that some of your realtors heard the stories. Well, my property is worth a lot of money because, I raised my kids here, and it's like, no, freaking care. Your kids are beautiful, but that doesn't make your property worth more, but they have this connection to that. Or they say, well, but I paid for that much. It's irrelevant. So they're anchoring their expectations on things that are just have no connection to what the property is worth, but that is what creating some of this mismatch between what things are worth and what people actually want for the properties, and sometimes quite a lot of discrepancy there. The other one, real estate is, once again, a new area of study. I know you're thinking, okay, real estate has been around forever, and it has, but as we discussed before, we really have data on real estate in the last 10, 15, maybe 20 years that data started coming. Until data is really there, all you can do is write theory. I'll show you academic papers being written in the 1980s, 1990s, and they're all theories, a bunch of letters, no numbers, and here's what we think things should happen. And there's no way to test those. Today, when we write papers and we do analysis, we're using a lot of numbers because we have data. Once you have those numbers, you can study things, you can actually apply valuation methods, etc., in order to get good valuations. But it's still very, very new. So if you have something that is very new, most people and most information is still not in the hands of everybody. Therefore, you create this discrepancy. Compare that to the stock market, you can get data on the stock market going a century back. I mean, what bonds traded at every minute, at whatever it is, I can go back a century and tell you what it is. Those things being studied for a very, very, very long time, so it's being perfected. In the case of the real estate, it just hasn't been around for that long. Even though the asset's been around, the information to study that hasn't been around. So you guys are here in a good time. The next one is size and economies of scale. So basically, let's say that I am whatever wealthy investor, and I found a stock that is selling for 50 and is worth 55. Okay? Let's say that this is the situation. What should I do? Buy as many of that stock as possible. Okay? Because I buy 50, it's worth 55. Soon enough, it will go to 55, and then I can sell it for 10% profit within a matter of whatever. Okay? You can basically create this economy of scale. You identify this opportunity, and you buy as many of that as possible. In real estate, it's very different. Because if I identify this one house that is worth 120, but it's selling for 110 or 108, 10% below, and say, okay, that's great. Buy me as many of those you can, but guess what? No, there's not as many. There's this one house that is worth 120 and it's selling for 108. Now, if you're a big investor that is sitting somewhere in New York, you don't even, it's like, whatever, just forget about it. I'm not even dealing with those $12,000 because it is not worth me the effort to come send somebody to check it, because the cost of me flying somebody over and checking the area, it's just not worth it. So we just don't touch it. Now, it doesn't mean that nobody touch it. Eventually, it's going to be somebody here local and say, sure, I'll take those $12,000, that's fine. But the idea here is that a lot of those big players will not even play that game. Even if they know that the inefficiencies are there, they're not going to take advantage of that, because it's simply they cannot scale it up. They can't say, you find that, okay, give me 100 of those. They could do that during different times. You talk about different times. So in 2009, 2010, 2008, where the vast of the market was undervalued, so you have properties that are basically selling well below the construction cost. So just to build those properties would cost, let's say, 200, and you can buy it for 150 with the land. And basically what companies like BlackRock said is like, hey, you, how about you work for me, go to South Florida and buy anything you can. Okay? But this is a very unusual situation. That's what they did. For a few years, they basically bought anything you could get a hold of. They have very few criteria of what they would not buy. They basically just buy any house you see between $100,000 and $200,000, I'll buy it. Okay? That is a very unique time in history. It's not repeating itself very often, so don't wait for that. But basically, generally speaking, you don't have economies of scale. So people will not take advantage of those $12,000 laying around because it's just not worth it. Then you, as the small investor that is local and willing to pick up those $12,000, you will pick it up. In the stock market, which is not going to be there, because the cost of picking this is just click, and everybody would click to get $12,000, but not everybody would fly somebody to check the property down in South Florida to make this. It's just not worth it.
Dr. Brokaw, I just have a question. When you say new area of study, you mean because now there's some sort of data to back up people's theories? Because there obviously were people who came into the real estate market, maybe from a totally different industry, with some disposable income that they had, and saw some kind of opportunity, not really knowing if it was going to pan out or not, but
they did not study the market. They
Right.
basically were buying it because they believe in an area. That was the analysis. I think South Florida is good, so I'm buying. What is your spread? And it worked for them because in the case of South Florida, it worked for them because it was a great story.
like in New York with big
Sure.
buildings.
Sure, so it worked for them, but there's no really, they didn't really study.
A lot of reporting too for like sales data, and you know, that's not an old thing. That's kind of newer within the recent history.
Jessica, go for example, if you go to the MLS and you look at like RE1 properties, how far do you think they go? I'm joking because Jessica is my research assistant and she's collecting a lot of data for me, so she knows how far they go. They go until really 2006, and before that they become, you almost have no data. You basically have about 10 years of data. Before that, you don't. Then you ask about, oh, why can't you go before 1978? This is actually amazing. We have it until 1978, and we actually constructed it a lot later. We constructed data that was spread all over the map, and people put it together in the 1990s and 2000. So now we can go back and study 78. It was not constructed from 1978. It was constructed in the 2000s based on some information, basically going to the county here and see how much this property is sold for, and go to the county there and see how much this property is sold for, and collecting all this information from different places, putting together. Going back to 78, now we have those. And even that is a stretch. And actually, to tell the truth, the early data is not as reliable. The later data is
MLS was
more
a
reliable.
book.
I'm sorry?
The MLS was a book. Realtors
Yeah.
had to carry around the disc.
So, yeah. So,
So then all those people from before that were like investing in these buildings, let's say in New York, were just at the right place
at the right
at the
time.
right time.
Like
Yes.
right now.
And they really were. They really were. Yeah. With a vision. Right? I mean, it's basically, yes, they took the risk and the right. Yeah.
Okay.
I mean,
Makes sense.
there's no, I bet you whatever you want that none of those investors, if you tell them, okay, so you bought this building, right? So what do you think you're going to be your rate of return? Which is, what is a more fair question to ask an investor than the most basic one? What do you think your rate of return is going to be?
Right.
I bet you whatever you want that 9 out of 10 of those investors would have a I don't know, what? Your rate of what? We bought it for that price, and we think it's going to be worth a lot more in 20 years because look what's happening here. That's basically the answer. It's like, a lot of waving hands, and we feel that, and they were right, except you don't hear about those that were wrong, right? Because those are the stories we talked about before. You don't hear about those, you hear about those success stories. But yes, there's no analysis there. So it is a new study, a new area of study. So, yeah. Just a few more factors and I'll show you evidence and go home. Dominance and control. And basically the idea is that you have no market where you have one particular company that's controlling the whole market. The real estate market is so big that the prices cannot be controlled for one individual investors. Almost everywhere you have many investors that are playing in the market. So again, you have this dynamic of prices are everywhere. There's really not large dominance. Then you have, of course, the fact that it's local markets. And the idea of local markets is the fact that, unlike in the stock market, I can sit in Miami and I can invest in stocks in China. First of all, I can invest all over the world with a click of a mouse, and I can get the exact same information as anybody else on the planet. I can get the exact same information. So if I want to invest in a company that is located in Atlanta, or a company that's located somewhere in Minnesota, or a company located somewhere in Orlando, whatever it is, me and the person that is right next to where they're located, we get the exact same information because we read the exact same reports that are available to everybody at the exact same time, and we can apply the exact same tools to analyze that. You don't know more about this company just because you live in the area. Okay? And the same thing about me investing in a Japanese company that is located in Japan, except that the report may be in Japanese, so I may need help to translate it, but basically I can analyze it the exact same way as everybody else. So the information is the same for everybody. That's what prices are more in line with values. On the other hand, in real estate, you have to be in place. Because you cannot just sit in New York and know just as much about this property just went on sale today in whatever, 157 and something, as the person that is really there. Because the person that is really there immediately know, no matter, you all get the same listing, I agree, but the person is there immediately know whether it's a good area or not. They maybe, if they live in the area, know that, well, it's because those people are getting divorced, so that's why we're getting a great deal on that. They also know that within 2 hours they can get into the property and say, oh, this is a terrible conditions, or it's not. Or all this information that you need to actually be in the place to know what's going on. You can't do it remote control from New York. If you're a New York investor, you have to send your own team to Florida to be here, and that's what you do. You cannot do it remote control from whatever it is because you're getting different information on the ground. Just the fact that you're reading the local news about, oh, the port is going this way and this road is going to open in that direction, all that, those are the things that people in New York don't know about because they just don't read the local paper. They don't, those are the kind of things that only locals know. So you as a local have a lot of advantage over everybody else. So again, your market becomes very small. And I know you think that Miami is a big market, but really is. If you think about Miami, it's a small market, and the professional investors within the Miami market is even a much smaller group. So you're really playing against very few players, and there's basically enough for everybody to have whatever they want. And sometimes there's more, and sometimes it's more difficult, but basically the fact that you have to be in the market is playing to your advantage. There's also a lot of markets where some big players, so maybe if you're a big firm in New York, you're going to say, okay, I'm going to send my team of few people to South Florida to buy properties because we think it's a good deal, but they're never going to send a team to Lawrence, Kansas, or to Laredo, Wyoming, or to Greenville, North Carolina, because it's just not worth your time. So if you invest in one of those smaller cities, you're really against nobody. In the small markets, it's true that there aren't as many opportunities, but you also have no competition. I know who I was playing against when I was investing in a place like Lawrence, Kansas. They don't know what they're doing at all because these markets are a lot less sophisticated. Now they probably know more than they have back then, but you have no big money really coming to the area that study those investments in a sophisticated way. Then you have whatever we call basically transaction costs. And transaction costs in real estate are high, which allow this discrepancy between value and price to persist. And what I mean by that, you know, I can buy millions of dollars worth of stocks for a few dollars. You know, if you have an account with Schwab or E-Trade or Scottrade or some TA Craft, whatever it is, I can buy $1 million worth of Apple tomorrow for a $10 commission. It's not $10. Come on, to buy $1 million value of something, it's basically free. Okay, so if I think that this 1 million tomorrow is going to be worth, $50 more, whatever, it's still worth it for me because it only cost me $10. I'm making those $40 free, no problem. In the real estate market, transactions are a lot more expensive. Two ways. One is time. Okay, it takes time and effort. It's kind of a pain to close on a property. Oh, I need this document in the item. Can you show me this? Can you back statement? All those. It's kind of a pain. Okay, and the fact that every time you buy and sell, it has costs associated. The cost can be quite significant. So closing costs, in terms of you having financing, and costs to agents can be significant. So if you bought a property that you think is worth $1 million, and you bought it for $950, is that really worth it for you just because of that valuation? Now, you should buy it for $950 because you think it's a good investment long term, but you shouldn't be buying it just because of this $50,000 discrepancy. Because just even if you buy it for $950 and you can sell the next day for $1 million, by the time you pay commission and any kind of cost associated transaction, you made no money. So you can maybe see this worth $1 million and sell for $950 and say, too bad, I can't do anything about it because transaction cost is too high. In other markets, you would immediately pick up those $50,000 because there's no transaction cost or the minimum. So transaction cost is a big factor of why some of those. So you don't pick up this property for $950, you do it for $1 million, but somebody else will. So the idea is that those deals stay on the market for a while until somebody who's suitable say, hey, this is worth $1 million, you can sell for $950, and it fits my profile, so I'll buy it. It's not going to disappear immediately. It's going to be on the market for a little bit until somebody finds it. In the stock market, disappear within milliseconds. Price reaction. Difficult to research. And fixation, those are the last three. So price reaction. You know, when the Federal Reserve, or Federal Reserve, I guess it's when the Federal Reserve is speaking once every whatever it is they meet, and they talk about their policy for new interest rates, there are millions of people that are listening exactly to every word they say, exactly. And if they say that the risk of whatever erodes slightly, immediately, not hours later or minutes later, but milliseconds later, the stock market is going to react by moving sharply higher or sharply lower in 1 second and less after they say those wording. Because last time when they talked 2 months ago, they said that the risk is moderate, and now they say the risk is moderate to high, so oh my God, that means whatever. So stocks going up immediately by a certain amount or going down by whatever amount. So the idea is that those assets that are liquid are reacting immediately to any kind of information, and then they reflect that new information. Now, if the Federal Reserve is deciding that we increase interest rates, so they're coming in December and they say we are increasing interest rates, and let's say that they're coming even with something very provocative, they're going to say we increase interest in a very significant way. Now, there's no question in my mind that the stock market will react to that in a millisecond, but the real estate market is going to be like, oh, okay. So how much were you asking for your property? 4.6. So what about now? It's like, well, I still want 4.6. Like, well, but the market is different. Well, I still want 4.6. The idea is that people would not react to this information all of a sudden. It's like change all the asking prices, higher, lower. They just don't. They would ask exactly the same thing they ask before they have this information, even though it should be priced differently. Because now we have another information to tell you that interest rate is different or it's going to be different, and all the value of those properties change because of this new information. The market doesn't react to that. So for example, if the value should be higher because of this new information, but it's not because people was like, well, I'm still asking whatever I was asking, then you can buy properties knowing that the price of them will go up because you just have this new information to tell you that the price is going to be higher, but prices are still where they're at, so you can buy them at today's prices and they will be higher. And on the other hand, if because of the new information, they tell you that real estate prices should go lower, but they're still not lower because everybody's still trading at those based on this old information, you can sell them today knowing that in the future they're going to go lower. Now, I'm not saying that you should use it as a trading strategy, but the idea is again that because the market doesn't react, the real estate market doesn't react to information immediately. Now, it takes time. After a while, if you're going to be too stubborn and asking too much money for property that's not worth it, eventually you realize that, okay, it doesn't work and you're going to reduce your price. But for a while, people are going to be asking and people are actually going to be paying the same prices as if they didn't have this information. In many cases, this information is extremely important. I mean, think about even like a major event like an election, right? I mean, we're going to have a new president in a few months, and whatever it is, it's going to have effect on the economy. One way or another, what's your opinion? That's irrelevant. The stock market is going to react to that in some way. The stock market for one candidate versus the other for whatever reasons, based on interest rate, based on free market, whatever. The stock market, people just, the real estate market, people are just going to keep the same prices on whatever they want because that's what they want. And day after the election, the day before, go check on MLS, see if prices change. They did not change. I can guarantee you that.
But when
Information, old prices. That is inefficiency.
David Beckham say that he's wanna buy surfing flag or this,
Say whatever
prices go like crazy and
They
then
can say whatever they want. The fact is that they don't react to information. It's difficult to research. Okay, think about again, stock market. In the United States, we have about 3,000 stocks. How difficult it is to research 3,000 stocks if you have a big company with 100 analysts? It's not that hard. Each one is in charge of 30 stocks. They're following them. They're writing a report every quarter. I study the whole market with one medium-sized company. Okay? I can study every single company in the market. If I want to study the whole real estate market, every single property is different. You have tens of millions of different properties there that each one is unique. You cannot study all of them. So that means if you can't study all of them, there must be some that you didn't study that may be selling for a price that you don't know they should be selling above or below that. And the last one is taxation. And taxation is the idea that sometimes people buy or sell for prices that they shouldn't be otherwise simply because of tax situation. What I just described to you with the 1039 and 1031. For example, people will knowingly overpay for property, let's say $100,000, just because they save $300,000 in tax. That is inefficiency. Okay? In a normal market, you should not overpay knowingly. You should never pay 5.1 for something you know is not worth more than 5. But in a market like this, because you have those special tax rules, people will do that. Evidence on that? I'm not going to spend much time on that, but I'll just refer you to that. We have under under 6, have those two papers, Bracha and Down and Bracha and Skiba. And this one, Bracha and Skiba, is on residential real estate, and this one, Bracha and Down, is on commercial real estate. But basically, you open, for example, the first one, which is the Momentum paper. Basically, what we show here is that real estate prices are predictable. And the way we show that real estate market is predictable is by showing that if you simply follow and purchase certain markets that did well in the recent history, they will continue to do well in the near future. So there's some kind of momentum. This momentum should not appear if the market is efficient. Because if you can predict something, it means it's inefficient. Right? If I know where the stock is going to be tomorrow, then it's inefficient. But I'm telling you that, yes, you can predict where those markets are going to be in the future. Using whatever pages of that we have here. You can read it. Like if you really like, if you can't go to sleep and go ahead. I recommend it's a good. Really get into those formulas. Make sure that you're really getting all the details. It will really get you to sleep. But because you already have to sleep, because it's almost 10, I'll just show you the things that will make you less sleepy. And basically, it's those three graphs. And basically, those three graphs, for example, if you're talking about this one. Basically, we have this strategy where you buy only in areas that did well recently and hold it for a short period of time in the future. And then you selling those areas that did not do well in the history and hold them for a short period in the future. So all you do is that you use information that is available at that time of how things in the past, which we all know, right? Things that held in the past, we know. There's data about that. And then hold them in the future. And here's how your performance would be. Basically, it means that if you started with $100 in 1983, you would end up using that long strategy of momentum. You end up from 100 in about 1100. You basically multiply your money by 11 times. And if you dealt with those areas that did not do well, so basically again predicting the future performance that will be low, it will be low. You start with 100 and you're going to end up with 100. So basically there is very high predictability of those prices. And the gap is not something that is sometimes closing, and it's basically the gap is being persistent, being growth over time. So we have this predictability of prices over time that we can show that is in the residential market. Now the details behind it, not for this class, you can read it over if you're interested, but this is basically what it shows. The other one is for commercial real estate. That's more recent. That's actually when I was here. And for this particular paper, again, you can get into details if you're interested, but I'll get you to things at the end, use these. Okay, again, the fact that you can predict returns, we do here based on two strategies. So first of all, it's the momentum. Just buying properties in areas that did well historically. Investing in those, holding the future. You bought those areas that were winners in the past, hold the future, that's where you're going to be, basically from 100 to 3,000. If you bought those areas that did poorly in the recent past, again, only based on information available, you're going to start from 100 and you're going to end up at less than 1,000. So basically you can outperform yourself 3 to 1 on the information you already have. So information has value. Unlike in the stock market, information has limited value because people already act on that information. So just because you buy a stock that did well last year versus not buying or selling stock didn't do well last year, you would never see this kind of description. Because if you would, that's what you do. But you say, okay, so what stocks did well last year? Let's buy those, hold them for another year, and do the same thing. But it doesn't work like that because the market is efficient. In real estate, it does. That is one of the strong evidence of why it's inefficient. And the same thing happened here, buying basically low versus high cap rate areas. Remember how we talk about, yes, everybody likes to invest in New York City and Miami and San Francisco, etc., where the cap rates are low because those are the glitzy, attractive, and sexy places. However, history and evidence show you that if you invest in those places, this is going to be your return based on information that you have. However, if you use the information buy in areas where cap rates are higher, your returns are going to be a lot higher. And the difference is almost at 2 to 1 over that time period, significantly higher. Okay?
Is it safe to say the opposite as well for real estate? Like, okay, like if you look at the historical data, and let's say, for example, Miami, this was one of the cities that did the worst during the recession. So can we also assume that if we have another recession, the city is also going to be one of the cities that Miami would be one of the ones to get hit?
So that's a little bit of a strong assumption because you need to realize that you need to to make sure that it happened for a similar reason.
Okay.
And if it is, then probably. So basically, if you have a recession that affects Miami, especially strong because of currency, and you expect to reverse it, maybe, but other than that, it's a strong assumption.
Doesn't that have more to do with like high appreciation areas anyways? I mean, the high appreciation areas are the ones that really see the most drastic values, where people, for the areas of the country that didn't have a lot of appreciation, really stayed stable.
Yes, it's better. Whatever goes up must come down, and some those areas more volatile are. Guys, Florida, South Florida especially, it's extremely volatile area, more volatile than almost any location, simply because of the type of the economy we're dependent on. We depend on tourism and money in other currencies. And when you depend on money in other currencies, especially from economies that are not stable, and those people are also the ones that are supporting all the tourism, you're going to have a very volatile economy. But guess what? This is good for intelligent investors, because when you have a lot of this, you can find these. But when you have these, finding that is not that helpful either. Okay, so you don't want a market that is very stable. For investors, actually having volatility is not a bad thing. As long as you know what to do with that information, as long as you recognize this, it's not bad. It's scary sometimes. Yes, nobody likes it when it's going down, but it's really where you buy opportunities. You don't make money when the stock market or when the real estate market is high. You really make money when things are low. People that made a lot of money is because they bought in 2009, 10, 11. People that buy today, they're probably going to be okay, down more than others, depends what they buy. But this is where this is not when you make the really big money. The really big money you make when everybody else is afraid. So this volatility is actually creating opportunities. So yes, we don't like it at the time, but it's what make intelligent investors a lot of wealth here. Guys, 9:55. Thank you for listening. Thank you for the good energy. I really do enjoy it. I'll see you next Wednesday.